By the end of this lesson, you will understand the basics of investing and why it's so important for building a secure retirement. You'll learn about different investment strategies such as index fund investing, individual stocks, and active investing. Plus, you'll gain insights into how to effectively manage and monitor your investments over time. My goal today is to simplify investing and show you practical ways to get started, no matter where you are in your journey. Let's start with a quick question. How many of you have already started thinking about investing as part of your retirement plan? Whether you're just starting out or already have some experience, today's session will help you understand how to grow your money wisely. Let's talk about why investing is so important. For most of us, relying on savings, pensions, or even a 401k alone may not be enough to sustain the lifestyle we want during retirement. Inflation eats away at the value of our savings, and the cost of living continues to rise. Investing, however, lets your money work for you. When you invest in the stock market, you're tapping into something called compound growth. Over time, your investments can grow exponentially, especially if you start early and remain consistent. Think of it as planting a tree. The earlier you plant it, the larger it grows. Before we dive into strategies, let's make sure we're speaking the same language. Here are a few key terms to know stock. When you buy a stock, you're purchasing a small piece of ownership in a company. Index fund. This is a collection of stocks designed to track the performance of a market index, like the S&P 500. Active investing. A hands-on approach where you regularly buy and sell stocks to try to beat the market. Diversification. This is the idea of not putting all your eggs in one basket, spreading your money across various investments to reduce risk. And here's an important point. The two primary goals of investing are growth. Growing the value of your investments over time. Income generating steady returns like dividends, which are payouts from companies to shareholders. Let's start with index funds, which are often a great option for beginners. An index fund is like a basket of stocks that mimics the performance of a specific market index, such as the S&P 500. This means when you invest in an index fund, you're essentially investing in the performance of the entire market, not just one company. Here's why index funds are so appealing. They have low fees, so you're not paying much to have your money managed. They offer diversification, which reduces your risk because your money is spread across many companies. Historically, index funds have delivered strong returns over long periods, making them a solid choice for retirement savings. Now let's talk about individual stocks. Some people aim to pick stocks that they believe will grow dramatically, what we call finding the next Amazon. While that sounds exciting, it's not easy. Here's why. You need to research the company's financials, leadership, and competitors. You must stay on top of earnings reports, industry trends, and economic shifts. And even with all this work, most companies won't deliver massive returns. Many fail. For beginners, this can be overwhelming and risky. That's why it's often better to focus on more diversified options like index funds. Active investing means you're buying and selling stocks more frequently, trying to beat the market by capitalizing on trends. This requires time to research stocks and follow the markets daily, a higher tolerance for risk. It's not ideal for beginners or those with limited time, as it can also lead to higher fees and taxes. On the other hand, passive investing, such as investing in index funds, is simpler. You buy the fund, hold it, and let time and compound growth do the work. It's much less stressful, and for most people, more effective in the long run. Start by deciding how much you can invest each month. A good rule of thumb is to aim to invest at least 15% of your income for retirement, but make sure you have an emergency fund in place first. To invest, you'll need a brokerage account. Some popular options include Fidelity, Vanguard, Charles Schwab, and Robinhood. Look for platforms with low fees and a user-friendly interface. A well-diversified portfolio might include index funds for steady growth, bonds for lower risk, stable returns, a small allocation to individual stocks, if you want to try your hand at picking winners. Check in on your portfolio a few times a year. Make sure it aligns with your goals and resist the urge to trade frequently. This can lead to unnecessary fees and taxes. Now let's do a quick activity. Imagine you have $50,000 to invest. Decide how you'd allocate it between index funds, bonds, individual stocks. Take 5 minutes to decide your approach. To wrap up, here are some key points to remember. Start investing as early as possible to take advantage of compound interest. Index funds are a great starting point for beginners because they're simple and low cost. Investing in individual stocks or active investing requires more time, effort, and risk. Consistency and patience are the keys to long-term success. Finally, remember that investing is a journey, and it's okay to start small and learn as you go. Please like and subscribe. See you next time.